if you don't know where to begin, better ask Win.
Shane, good to see you. This is everyone's reminder. Don't let the IRS keep your money. Yes, it is December, but we have a few more year-end tax moves for you. Most of these moves have to happen before December 31st, so it's not too late, but let's talk it through. First, max out your 401k. What can we do?
Well, you have a $23,500 contribution limit on your 401k. So if you can inch up your contributions from your payroll to that account, that'll help you get some money saved for retirement and get a tax deduction this year. If you're looking at a micro perspective for tax planning, that can help you reduce your tax obligation for this year. But if you have more of a macro perspective for taxation, you might want to look at the Roth 401k option, which you might have as well, and utilize those both in conjunction to your advantage.
And next, if you have a high deductible health plan, make sure that you are contributing to your health savings account, which is uniquely triple tax advantaged.
It is. I have one myself. It's a good tool to put money into, get some tax-free growth, and take it back out tax-free for healthcare costs in the future. So make sure you put some money in there, max it out if you can. Good tool for tax-free growth as well.
And then even though you do have until the tax filing deadline, this is a good reminder, again, to all of our procrastinators out there, to max out your Roth IRA.
Yes, these Roths are big. I always try to focus on maxing out the Roth because the Roth is tax-free. In the future, that money will come back out tax-free. It won't affect things like your Social Security tax, your Medicare premiums, your ordinary income tax brackets, or your capital gains brackets. Yes, the money goes in today after tax, but that advantage on the back end is huge. And if you have an eye towards lifetime taxation and you think taxes in the future might be going up, great place to put money to make sure that you don't have effects upon you in the future.
It's also a good time to consider selling your stock losers. This is something we've talked about before, tax loss harvesting.
Yeah, this is an interesting concept, but basically it's the idea of selling some things that are down that you don't think are too likely to come back up, and kind of using those down losses rather, to offset some of the gains on your other appreciated assets that you might be selling inside of a non-qualified account, so that you limit or maybe even neutralize some of the taxation that you might owe on those other things that were winners.
And last, be tax smart and do good, donate to charity.
Yes, and if you are charitably inclined, there's ways to move money in very effective ways using qualified charitable distributions to make sure you take money from a qualified account to the charity tax-free. That's a great tool that many people overlook sometimes, especially if they're inclined to contribute to charity, to church, or the like.
Yeah, no, absolutely. If you're tithing anyway, there's a tax efficient way to do it where you both win. So again, Shane, we're creeping up on the end of the year now. Not too late for some of these moves, but always a good time to start planning for 2026. So if somebody would like to talk to you about being tax smart in the year ahead, what's the best way to reach you?
Best way to reach us is online or via phone. Our website here is winstonandcompanies.com, or call us directly at the office, 602-456-1928.
Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask Win.